Okay, here we go. So we are now live. So we'll give it, yeah, like you said, we'll give it a couple minutes, let a few people get on, and then we'll get started. I would say we give it another, what, 2 minutes maybe?
Sure, that sounds good.
And then we'll just see, let's see. I don't want to bring it up on my side. Okay. So the crew says we're live and we look good, so that's a good thing. Nice. All right, guys, so bear with us just one more minute. We just want to let a few people get online here with us. Uh-oh. Wait, we can't hear you guys. Oh, shoot. Okay.
Can you hear me when I talk?
Okay, Dev, let us know if you can hear Tyler or if it's just me.
You can hear me, right, Tyson? Because I can hear you.
I can hear you clear, yeah. Here, I'm going to just give her a quick call, make sure everyone can hear us okay. Hey, can you hear myself and neither?
Someone can hear you.
Oh, got it. Okay. So maybe it's just on your side? Okay. Okay, we'll have more people chime in. Okay, sounds good. Okay, well, we can hear each other great, so I'm hoping everyone else can. So, okay, cool. Okay, thanks. All right, bye. Okay, so they're having issues hearing us, but it sounds like others can hear us. So let's see here. Okay, so I'm on it. I can't see or hear anything. Very good sound. Frozen. I can hear everything. Okay. Nice. Okay. Can someone else comment? Can you guys hear us okay?
And I'll talk real quick to make sure you can hear me as well.
Perfect. Okay, so it sounds like we're fine. So I think we just get going here. If there are any technical issues, okay, looks like most everyone can hear us just fine. So welcome, guys. Thanks for tuning in. Today we're going to talk a little bit about creating wealth in real estate. Topic I'm really excited about, and I've been sharing a lot lately with my crew and with a lot of other people. And the reason I'm really excited about this topic, and we definitely appreciate Tyler being here with us, who's going to be presenting a lot of good information for us, is it's a lot. I wish I would have done or purchased more properties at a younger age to set myself up better today. Because obviously a lot of wealth can be built through real estate in a few different ways, which I talked about a little bit a few days ago on a video that I put out, which of course, you know, if you have money sitting in a bank, you're making maybe 1%, 2% on that money. In real estate, you have the opportunity or the potential of making 6, 7, 8, 9% on your money, but that's just one piece of it, because you're also buying an asset that will over time appreciate. And then also you have tenants that are paying down your mortgage over time. And I'm sure Tyler's going to get into the nitty gritty when it comes to investing in real estate and why it is so beneficial for us to purchase real estate. And so I've already purchased one property with Tyler. I'm currently purchasing a second one. the first one was in Memphis. Second one is in Orlando. Also have a client of mine that is in the process of selling her properties and then purchasing multiple properties in Orlando. And the reason we're doing that is because for her, the return on her money is much greater in other markets other than our local market here. It's challenging to find a property to where you can go in with 20% down and make anything more than 4 or 5% in our market. Whereas there's other markets such as the ones we just mentioned in Memphis and Orlando and probably a couple others where you can make 6, 7, 8% on your money. And they're great markets that have the potential of a lot of growth. And so this strikes, or I love this topic because I feel like it's something that's going to help me be able to better prepare myself for retirement. And so it's something I really wanted to share with everyone else or have Tyler share, just because I really want everybody to be smarter with their money. And I think real estate is obviously a great way to invest your money to set yourself up for the future, set yourself up for retirement. Because I think we all know, definitely, I would say a good majority of people, by the time you're getting to the age where you want to retire, you're just not ready. So I think he's going to share a lot of good information that's going to help us understand how we can truly invest in real estate and set ourselves up better for when we get to that stage in our life where we want to retire, where we want to have more passive income, where we want to have more assets to allow us to retire and just set ourselves up better to where we can do that. So, so those are just a few of the things that Tyler's going to be going over. He's got some slides he's going to share with us. We're honored. We're grateful that you're here with us, Tyler. I'm going to go ahead and pass the time over to Tyler, and feel free that throughout this video, if you have any questions, thoughts, or anything you want to bring up or clarification, feel free to just shoot us a message, and we'd be happy to answer. So anyway, I'm going to pass the time to Tyler. He's going to give us a little bit of an intro. I know he's helped thousands I believe thousands of people purchase properties. So Tyler, take over from here.
Good. Thanks for having me, Tyson. I really appreciate it. So yeah, tonight we're going to talk about real estate and some of the nuts and bolts of a system that I've created that helps people create passive income. You know, at the end of the day, so many people out there bought into this system of, I go to college, I get an education, and I get a good job. I live responsibly. I put money in my 401ks, in my IRAs. I save money every single month. I save for my college or my kids' college tuition, and I'm doing everything right. And in reality, I'm in the top 5–10% of the entire country. And we start to get older, and we're now 40 or 50, or we're 10, 20 years away from retirement, and we realize that $400,000, $500,000, $600,000 that we have in retirement, that $200,000, $300,000, $400,000 we have in equity in our primary residence isn't enough. We haven't built a big enough bucket to provide the type of cash flow that we want to live the retirement that we've always dreamed of. And the result is, if I want a $75,000 a year lifestyle in retirement, which isn't some lavish retirement where you're taking your grandkids on Disney cruises and doing all these things, the reality is we're going to deplete the bucket before we're dead, and we're going to be short, right? And you know, I use an extreme example of, we're going to be greeters at Walmart because we have to go back to work because we ran out of income. And so really, my whole system, my whole model is centered around solving that problem, which is let's create an asset base. And real estate by no means is the only solution, but let's create an asset base that provides that income for us without depleting the bucket. You know, Tyson mentioned it's an appreciating asset that also provides cash flow. So that's my model. I'm excited to kind of share it with you, go into some of the details of how we do it. But first, just a quick introduction to me. Who's Tyler? I live in Salt Lake City, Utah area. And I know a lot of you are down in California, in Southern California. It's 39 degrees and the wind is blowing 25 miles an hour right now outside my office. And it's going to be 22 degrees tonight. So fall is in the air and winter's coming where I'm at. And we're getting prepared for it. I do need to, tonight, still need to go and turn off my sprinklers, blow out all the water so the lines don't freeze tonight.
Dang, so, that's crazy.
Yeah, a world you don't have to worry about. So be grateful for that sunny weather out there. But I've been in real estate since about 2003, and the system and path that I'm going to talk about tonight, I've applied in my own life, and I'll show you a couple examples of what it is. But I've been in the lending side of it, the insurance side of it, the real estate or the acquisition side of it, and so I understand all the different pieces. And I've been through market ups, up markets, flat markets. The biggest crash we're probably ever going to see in our lives, back in 2007 and 8. And then this pending recovery that we've had over the last, 10 plus years. And I've tried to create a model that works in all of those different types of markets. And it's not dependent, or it only works in an up, flat, or down market. And so we'll talk a little bit about that. A little bit more about me really quick. I've been married for 15 years. Just had my 5th kid. Call me crazy. It is, but I've got about a 1-month-old little boy, 2 other boys, and 2 girls at home. And I work. I do what I do, for them. And like so many of you, and I think one reason why I've really enjoyed connecting with Tyson and getting to know him is the why behind what we do. And I want to commend Tyson in front of all of you, because behind the scenes, the conversations we're having, it's all about how do I provide more value to my clients, right? And those are the conversations that him and I are having. And I think it's so neat that he takes the approach of, if I can add more value to my clients' lives, I want to share it with them. And, I think that's what tonight is about. It's not about him making a ton of money, because in reality, him sharing this model doesn't necessarily provide a ton of revenue and profit to Tyson by any means. But what it does do is provide his clients with more education, more opportunity. And I really like working with people that have the understanding, if we do the right thing for our customers, for our clients, that sooner or later we know that we're going to benefit. And whether it's from a thank you card or referral or whatever it is, if we err on putting our clients first and their needs first, that it just always works out. And so I've really enjoyed getting to know Tyson, working with him, and the perspective that he takes for you guys. So Tyson, shout out to you for that.
Thank you. No, I appreciate it, man. And that's truly what it is. Very well said. Thank you.
Yeah. So I'm going to turn this screen, and I'm going to share my screen with you as we go through this. And I'm going to start off with the story about my first house, because this is how it all started for me. Back in 2004, this is the house that my wife and I bought, and I still own it today. I lived in it for 12 months, and I moved out. Okay. And when I moved out, well, I bought it in 2004 right here for $130,000. Okay. Seems really cheap. We got to remember that was a long time ago. And this was Utah, not California. And today the value is $250,000. So I'm up about $120,000 in value. When I moved out of this house in 2004, the monthly cash flow is $25 a month. So in all reality, or in 2005 when I moved out. So in all reality, when I moved out, it wasn't a great ROI from cash flow. It wasn't a great investment, but I knew I wanted to start building my investment portfolio. I was young and knew that this is a good way for me to start. Well, today, the monthly cash flow is $550 a month. And that's because rents have gone out that much over a 15-year period of time. And so I'll talk a little bit about how we underwrite houses and the assumptions that we have. One of those that's built into our underwriting criteria is this rent increase over time. And this is a very good example of how that happens. So now you take a summary of this house. So that $25 turned into $50, turned into $100, turned into $200, that's now $550, has given me a total of $50,000 in cash flow. So actual cash deposited to my checking account, $50,000 since I've owned this house. Well, my tenants have paid down the principal $60,000. And you're going to hear me talk about this as we go through tonight, but I call that deferred cash flow, simply because you're not getting it today, but you're guaranteed to get it tomorrow because the principal amount's going down. All right. So all in all, I've gotten $110,000 in cash flow. My value of my house is up $120,000. I have $230,000 of total profit. I haven't hardly done any work on the house. Physical time, I call that mailbox money, and that's the power of real estate, is you can make money while you're sleeping or while you're working or while you're on vacation or whatever it is. That rent continues to come in and the appreciation still happens, especially over a long period of time. So the summary of this house, if I were to look at that $130,000 in cash flow that I've gotten, or $110,000 in cash flow and $130,000, the summary is I make 19% in total cash on cash ROI. So that $50,000 cash that I've received over the years, it represents 19%. If I include the principal reduction into that, it's 32%. Now, if I add in the appreciation, so if I sold that house today, I walked away with the $230,000. I divided it by the capital that I've put into the house, divide it by the 15, 16 years I've owned it. It represents a 41% annualized appreciation, which is just crazy. And I'm not going to go and show you examples of 41% of ROI or even claim that we can go get this. But the value, the main point that I want to make with this particular example is the power of time. And just how powerful owning real estate for a long period of time is. Because, I bought this in 2004, so values went up for 3 years, then it crashed, and then it's gradually gone back up over time. And so really, this is the model, and this is kind of the foundation principle by which I've built this, is all based off of cash flow, buying the right types of properties, and then holding them. And benefiting from the value of time through your portfolio. I'll show you this slide really quick. I referenced it in the beginning, but this is just the current state of America, which is really crazy. 30% of Americans have no retirement savings, none. 23% have less than $10,000. So over half of Americans don't have any retirement savings. And you get all the way up to only 13% have $300,000 or more. So when I was talking earlier about that person who's gone to college and is making a good salary and living responsibly, getting ahead every day, the reality is that person falls into this 13% category, but it's just not enough for so many people. There's such a small percentage of people that are set up that they have enough income to sustain them through retirement comfortably. And so this is kind of a solution to that. So one of the reasons, I believe in real estate, and I believe it's such a great asset to have as part of your portfolio. These are some of the main reasons. So number one is it's a tangible asset. You can touch it, you can feel it. And I believe there's benefit to that versus just holding, stock or paper or some of the other types of assets that are out there. Another one is depreciation, which gets you tax savings today. One of the questions I often get asked is, well, if I cash flow from this property, that's income, is that taxable? The reality is you can depreciate these investment properties over 27 and a half years. You divide the value out, and your CPAs or accountants can do all of this for you. But the savings you get in depreciation pretty much offsets the income that you would have to realize from the rent and the percentage of principal pay down, that there's not much tax obligations. However, you have the actual cash flow in your pocket. So there's a lot more strategy as well through estate planning, succession planning, where real estate is just a smart asset to have as part of your portfolio. And there's a lot of benefits, especially through succession planning, where you can, upon your death, your real estate portfolio, a good amount of it can be passed along to your beneficiaries tax-free, and their basis automatically steps up. So it's really cool. I won't go into all the details of that, but just know that there's a lot of tax benefits through real estate. The owner's in control, and you're the decision maker. It appreciates over time. Any extended period of time that you look back over the history since single family residents have been around, you're always going to see appreciation. You've got that deferred gain, you've got cash flow, and then you've got recession proof. And I'm going to talk a little bit about the recession proof and how my strategy fits into that. The next thing I want to talk about is just what type of real estate. And there's done right, there's a lot of good ways to invest in real estate. You can do commercial, office, retail, storage units. You can go out and develop. You can buy raw land and you can develop it. You can develop houses. You can do new builds. You can do flips. You can do industrial. You can do residential, right? And I don't talk down to any single type of real estate because, again, done right, I believe you can be successful in all these different areas. However, I have certain criteria that I use when I want to identify what type of real estate do I want to do and how do I want to do it. And based on the results that I want, the amount of risk I'm willing to take, what's the single best type of real estate? And I want to talk a little bit about just some of the criteria for this. So the first one is create, and I'm going to use a money analogy. And if we were all sitting in a room and I asked you to raise your hands, I'm going to guess that all of you would raise your hands to the question of, do you know somebody that has figured out how to create income? So that makes a good income or gets paid good wages, but lives paycheck to paycheck. I think all of us know somebody that fits that criteria, right? And the reason being is because they figured out how to create, but they haven't figured out how to manage, how to budget their money. And then if I ask part two of that question of, do you all know somebody that's figured out how to create money and they also manage it wisely, however, they lack protection? So from a money analogy, it could be, oh, they're making good money, they're living frugally or responsibly, but they don't have any life insurance. Well, y'all, if they were to get hit by a bus on the way home from work and that income stream disappears for a spouse, it doesn't really matter how good they managed if they didn't protect, right? And so many people get so caught up in this, especially millennials, right? I want to make money, and they forget how important it is to manage it. But then so many people are left exposed from the protection element because they don't protect it wisely with, life insurance, disability insurance, or estate planning, or holding your real estate in LLCs to separate personal assets from business type assets, all these different elements of protecting your money. And then ultimately, if we execute on all those, we're going to grow. Okay. So when I went out to say, how do I do this in real estate and how do I fit this criteria? This is how it works. And this is kind of the model I've come up with. So under the create, you really have access to markets and types of houses. It all starts with what house are we buying and where? And a good analogy to this is let's imagine, Tyson, let's say that you've got $250,000 and we're sitting across from each other and I work for Fidelity Investments and I'm a stock guy. And I'm interested in managing your portfolio, and you're interviewing me as a potential solution to manage your stock portfolio. And we're sitting there talking about index funds or different stocks or different options that you have. Well, you live in the Southern California area, and you would never say to me, well, let me ask you, would you say to me, hey, Tyler, I'm comfortable if you fill my stock portfolio with houses within about 30 to 45 minutes of Temecula, California. And I only want companies with headquarters in that circumference in my stock portfolio. What do you think your stock portfolio would look like?
So within 30 to 45 minutes.
So I can only buy stock with companies with headquarters that close to you.
Oh, shoot.
We'd be very limited, right?
Oh, very limited.
Could we buy Amazon? Could we buy Apple? Could we buy ExxonMobil? Home Depot? Right? None of those. Yet, and I would never want to just offer you stocks in the area where I live. However, so many people take that mindset with real estate. And maybe because it's a tangible asset and they want to be able to drive by it or touch it or feel it or something. But they take the approach of, well, I'm comfortable buying stock in companies with headquarters all over the country, but for real estate, I only want to buy in my own backyard. And so I kind of flipped that on its head. And back in 2008, when I started to grow with this model, I was only buying real estate in Salt Lake City area. But I started getting clients from all over the country through word of mouth referrals. And then all of a sudden I started asking myself, well, this guy in Seattle, this girl in Chicago, this person in Denver, why would they want to buy in Salt Lake? Like, what makes Salt Lake so special? And so what I decided to do was go out and analyze. I analyzed about 300 major markets, just like a stock guy should go out and analyze a bunch of companies to determine what markets offer the best returns and the best options for my real estate strategy. And once I determine which markets, because what I can't do is I can't control how the market is, but what I can control is my understanding of how each individual market is responding to the overall real estate market. And then I can identify which ones are the best, just like picking stocks. So I go out and I give my clients access to markets where it's going to perform the very best. And a good example, your market's pretty similar to my market, but if we were to go back to 2008, when it just tanked, right? Prices were way down, and you have this what rents are and what prices are. And if I were to kind of draw a chart, so if you can see me right here, so if rents are right here, prices are right here, what's happened is prices have gone like this and rents have gone like this, and now this gap is really wide. Prices have grown at 5 to 10% for 8, 9+ years. Rents have grown at 2 to 4%. And so you have this market where rents to values or to purchase prices aren't as strong in some markets as they are in other markets. Some markets, the values or the prices haven't grown as fast. Others, the rents have simply just kept up with it. So that's one of the factors. I get asked a lot, what are all the different factors you look at when determining markets? Population growth is one of the huge ones because population growth stems real estate, right, and housing. But job creation, unemployment, affordability is a huge one. You know, average wages to average home prices and average rents and affordability. You know, currently in Utah, we're having a big affordability crisis, and we're right around the corner from seeing a slowdown simply because home prices have outpaced wage increases for 9 years in a row. And at some point, they're just going to become unaffordable for the wages that people are getting paid. So we look at all these different factors to determine what market do we want to be in. We go and we set up infrastructure in those markets. So we do acquisitions, property management, repairs, maintenance. We handle the lending, the insurance, just all those pieces. So it's a really turnkey, hands-off position. The next thing under the creation is the types of houses. So we are very specific in entry-level single-family homes. And I'll show you some examples of these in a few minutes. But entry-level single-family homes, 3-4 bedrooms, 2.5 bath, 2-car garage. And
the reason we pick these houses is because in real estate, upon purchase, so when you buy a property, you know exactly what that tenant is going to look like. So you can target a certain tenant type based off of what you buy. And if we went, excuse me, if we went out and bought multi-unit, a fourplex or a duplex, we know what that tenant's going to look like versus a tenant that's going to be renting a single family home. We know that we have to budget for a little bit higher turnover, a little bit lower income probably, and it's just a different type of person. Where if we go out and buy some luxury house on the beach and want to Airbnb it, we know what that person is going to look like too, right? So we target these tenants, a certain type of tenant. The average tenant in our houses in Orlando, for example, the average household is about $50,000 to $60,000, $65,000. The average rent's about $1,400 to $1,500. So you talk about affordability, that's phenomenal. Those people could qualify for a mortgage all day long. They're just choosing to rent, right? Their ratios are in line. It's super affordable for them. And we've got somebody in there that can afford the rent that they're paying. And then also, one of the downsides to real estate is liquidity. You can't just get your money tomorrow if you want your money necessarily. And so that factor is part of the criteria that I've identified as the type of houses that we get. And what happens is these entry-level single-family homes, one, have the highest percentage of renters in the entire country. If you look at the rental pool that are out there, more people rent an entry-level single-family home priced at or below the median house for that area than any other asset class type of real estate. And then number two, when the market's up, we want the ability to be able to sell. And when we have an entry-level single-family home, we have a lot of customers because it's the most transacted piece of real estate, and you have a primary buyer. And they buy when the market's up because emotions are high and they feel like they got to buy now or they're not going to be able to afford if it keeps going up. And there's a lot of volume of transactions in that type of asset when the market's up. Well, if we have a fourplex, for example, not to say fourplexes are bad, but when you sell a fourplex, your target customer is an investor. And investors typically aren't going to buy when the market's up. And if they are buyers, they want to buy at a discount or they want a deal. And you have a lot smaller percentage of potential customer. And so I really like these single family residences as the type of house that we buy. And it all starts with the markets that we're buying in and then that type of house. And I tell everybody, we can buy the right house in the right market for the right price. And if we have the wrong management, it can end up being a bad investment. Right? If Tyson wasn't as good at managing properties as he is, if he's not collecting rent, if he's not screening tenants properly and he's having a huge default rate, or if he's not properly keeping eyes on the properties and they're getting just trashed and he's not aware of it and notifying or taking action, then you can end up sinking a lot of money into that particular house and not getting the ROI that you want going in. Is that true, Tyson?
Oh, for sure. Yes.
Yeah. And so we go out and we buy the best, we identify the right markets, we buy the right type of asset inside of those markets in the right locations for the right prices. But then we also have the property management piece in place. And that includes repairs and maintenance. Tyson, would it be possible for you to increase costs on ongoing repairs and maintenance more than you need to, and you probably could get away with it? Could you hide profit in repairs and maintenance if that's the type of business you wanted to run?
Oh, of course. Yeah.
What I've found is a lot of property managers, unfortunately, make excess margin in repairs and maintenance simply because their investors or their clients are just unaware of what they should be paying for those types of things. And Tyson doesn't do this, and I'm not alluding that he does by any means, but what I have found is that because we go into these markets, we transact a high volume of homes, For example, in Orlando, our property managers manage over 700 houses for my clients. And so we're able to keep repairs and maintenance costs down with economies of scale. We're able to keep the actual property management costs down and get very competitive pricing without sacrificing service. And so we find the right management play piece for this, and then protect. So cash flow. Cash flow to me is the ultimate protection in a down market. And if we only buy assets that work in an up market, we're going to end up losing because nobody can tell the future. And I especially don't claim that I can. I like to think that I'm plugged into the market and analyze and have a lot of data and information flowing. But at the end of the day, I don't know what tomorrow's going to look like. However, I want to hedge that. And I want protection in my portfolio as much as possible. So one of the questions I get asked, what happened to your clients that bought in 2007 at the peak? What happened in 2008, 9, and 10? And I love that question because the reality is they bought an entry-level single-family house. Most of those clients at that time were in Utah. So the average price back then, let's say it was $225,000. They're renting that house for $1,450 and they were cash flowing $300 a month, making 6-7% on their money in 2007. Then all of a sudden the floor fell out. The market tanked. And now that house went down to $160,000. Did it drop in half? No. Did we have houses in Utah and all over the country that dropped in half? Absolutely. But it was typically the higher end houses that were above the median prices for those areas that got hit the hardest percentage-wise. But what happened to rent? Our vacancies actually improved and our rents actually increased from 2008 to 2010. Reason being is because we have more customers. There was more demand for our product and we had the supply because people were losing their houses. They needed somewhere to live and we had the affordable houses for them to live in. And so that's your protection element in this model is let's have the type of house that can withstand market slowdowns or market fluctuation. And what are we doing today with those houses? Well, we're selling those houses for $385,000, right? Because they held them long enough. So the whole goal with this is to create, manage, protect, right? Fill your real estate portfolios with the best type of house in the best market based off of market conditions, manage it efficiently to maximize returns from cash flow, and protect it by the strategy and how we buy what we buy. And then ultimately, we're going to grow your portfolio. And what we do is we strategically buy, sell, and hold. And what I mean by that is I manage your portfolios, my team manages your real estate portfolios, just like a stock advisor would manage your stock portfolio. So if you have a good stock advisor, he should be sitting down at every 6 months, every year, reviewing your portfolio, the performance of it, talking about any changes in your life, what's changed financially, what's important, analyzing risk tolerance and time frames and all those different things, which I like to do from a real estate standpoint. Because I want you to know exactly how your real estate's performing, what's going on in the market that you own the real estate, and identify any opportunities. So for example, we bought a ton of houses in 2010 to 13 with our clients in Las Vegas and Phoenix. They were on clearance and we bought them. And those houses today have nearly doubled in value, but rents have barely gone up. So we're able to go to those clients and say, hey, you paid $135,000 for that house. It's worth $225,000 today. It was renting for $1,200. It's only renting for $1,350. The reality is with the value of that asset, you're not getting the ROI that you could be getting with the amount of capital that you have in there. So let's sell in that market and let's go buy in Orlando, for example, and let's turn one house into two houses or three houses and double or triple your cash flow with the same initial investment. And so the one thing that doesn't make sense in real estate is if you own real estate in one market and that market's up, well, if you sell in that market and rebuy in that market, you're not really getting ahead from a wealth standpoint, right? If you sell high and buy high, you're not really winning or advancing. The only time that makes sense, in my opinion, is if it's a primary residence and you have a reason to move because your family's growing or school zones or whatever that case is. But what we're able to do is if a market's up and there's a better market to buy in the country, we can go and analyze what would it look like to sell today and then go and buy in a different market. And the only reason we would ever recommend doing that is if we can advance or grow your portfolio. So that's kind of the strategy of how it works. What I'll jump into real quick is the markets that we're in. I'll do a brief summary of the markets that we're in, and then I'll just show you a couple of house examples. Does that work, Tyson?
Sounds good. Thank you.
Any questions up to this point that anybody's thrown out or anything you want to add, Tyson?
Nothing yet. Looks like no questions at this point, guys. Feel free to chime in a comment. We'd be happy to answer any questions you guys have.
Okay, so I talked a little bit about Orlando. Appreciation is really strong. Population growth, it's growing like crazy. What I tell everybody is out east, think of all these baby boomers that are retiring in New Jersey, New York, Boston. One, they're expensive states to live in. They have state tax, income tax. The weather is cold. And so you have all these baby boomers that are, and real estate's expensive. So they're retiring. They're coming down to the Orlando area. And, I tell everybody they use salt up in the Northeast to melt snow, and they use salt in Orlando for margaritas. Right. And so they come down, they buy a house on a country club for $350,000 and they consume. They create jobs. They don't come down to work. They come down to consume. And so they create a ton of jobs down there. So you have that happening and projected to happen at a very high level for another 10 to 15 years. If you look up a city called The Villages, it's about 45 minutes outside of Orlando, but the fastest growing city in the entire country in 2018, and it's all retirees. And so all the little surrounding cities around it are benefiting, and they can't build housing fast enough because there's so many jobs that are getting created, right, from that. It's the number one city for tourism in the entire country. By it has 30 million more visitors than New York, LA, or Las Vegas. So a lot of tourism comes there, and then it's just affordable. If you look at the average home price is $238,000, and the average rent is $1,500. I don't know what it is exactly in Temecula, but in Salt Lake, the average home price is about $375,000, and the average rent is $1,700. And so you can see just that gap is huge. So it's not as efficient to buy in Salt Lake as it is in Orlando. So what do we buy or what does it look like? Here's an example house. And I realize these numbers are kind of small. We'll send out this slide deck so you can actually look at it. But this is a pretty average house out there that we buy. It was built in 2006, 2,200 square feet, 3 bedrooms, 2 bath, 2-car garage. Okay. And this is the process that we go through when we underwrite a house. So we get all the information on it from our teams in that market. We go through, we plug it into these pro formas and underwrite it, and it either works or it doesn't based off of all the numbers. But this particular house is $176,000. So if you look right here, purchase price $176,000, and you have all the costs associated with the down payment, your closing costs, any rent-ready rehab. So total property investment is $50,000. So that's the number that I use to calculate your ROI. And this house rents for $1,475. So again, you look at $1,475 into $176, and that's just really healthy. It's called gross rent multiplier, but that GRM is very healthy compared to other markets. You're buying at a 7.48% cap rate. And so what happens is we have all these things built in. We have vacancy and repairs. We have lease up costs, we have your mortgage, your insurance, your taxes, HOA, all those different things. And it spits out basically a profit and loss. This particular house is going to cash flow $320 a month right here. That represents on your $50,000 investment a 7.58% return. So that number that Tyson was talking about, that 6 to 9% number, that's what he's talking about. And that's the actual cash flow that you get. With the principal pay down, that represents an additional 4%. So out the gate, you're really making almost 12% return on your investment from the cash flow. And that's what we base all of our decisions off of, is the cash flow. Well, we know that the home over a long period of time will appreciate. And so we have that factored in, but that's kind of icing on the cake. We don't make a decision based off of the appreciation. So if you look at the summary, you have this 5-year cash on cash return average of 7.85%, 7 years. And then at 10 years, that goes up to 11.65%, simply because rents go up over time. If you add in the principal pay down, you're seeing 16% returns. And then if the market appreciates and goes up, you have the potential of making 30% on your money, right? So I like to show that, but again, we don't plan on it simply because we just don't know exactly what that's going to look like. But the cash flow is very, very predictable, especially with these types of homes. One of the other markets, and again, I won't spend a ton of time going through all the details, but is Memphis, Tennessee. And the reason we buy in Memphis is because right now when you go shopping for real estate, like if you were to walk into Nordstrom's or somewhere or Trader Joe's, typically there's going to be some sort of sell rack, some sort of clearance rack that you could go to. Well, right now, there's not much real estate on sale. There's a very low rate of foreclosures and short sales. So there's not very many deals in real estate, simply because the market's been up for a lot of years in a row. People are making good wages, unemployment's low. And so based on understanding the overall market, Memphis is a market where you're not going to see huge growth. But if you look back over the dot-com boom and bust, the 2007-8 boom and Great Recession, and look back over all that, you're going to see a market that just has these rolling hills, not these crazy steep roller coasters and mountains and cliffs of values. And so when you look at what rents are to home prices, Memphis is just really strong. So it's a really good cash flow market where you're not going to see a ton of growth, but based off market conditions, it's one of the best cash flowing markets in the entire country. So a sample house in Memphis. So this house, I'll make it a little bit bigger here. So this house is built in 1989, 2,500 square feet, 5 bedrooms, 3 bathrooms. Okay, it's $195,000 and rents for $1,600. Your cash on cash ROI is about 8.75% that you can see right there. Over a 10-year period, you're at 11%. So I won't take the time to go through all the numbers on it. The one thing I will say about this particular house is every house has its story. So this house was purchased wholesale by a supplier that is one of our contacts for providing properties. And they went in and put a new roof, new AC, new water heater, new furnace, flooring, paint, any of the big capital expenditures you might expect to have on a home that is built in 1989 are all updated. So by the time our clients buy it, there is very little projected, or ongoing repairs and maintenance that they're going to have, especially some of the big ones that you can predict during the due diligence period of it. So that's example of one of the houses out there. Here's another one in Memphis. This one was built in 2002. It's 2,000 square feet, 3-bed, 2.5 bath, 2-car garage. And if I were to show you the last 100 houses we did, you're going to start hearing the same things over and over. 3-bed, 2-bath, 2.5 bath, 2-car garage. Like Tyson mentioned, we've done just over 5,300 houses for our clients, for about 1,600 people at this point. And I can proudly say that the overwhelming majority of those clients are all repeat and word of mouth based, because we really like to build game plans and customize them for every client, and build a relationship and have ongoing management and consulting as we work with them. And Tyson, we had one of your clients, maybe you can talk about her just a little bit about what we recently did for her.
Yeah, definitely. And we've also got a question, which I'll shoot out to you here after. But yeah, we've got one client who we managed multiple properties for her. Off the top, oh, you know what? We actually managed about 5 or 6 properties, maybe more. And we've already sold 4 or 5 of her properties. And so we've been managing it for a number of years. Her return's decent. She bought them some of them at better times. But she ended up selling 4 or 5 of her properties, and she's in process of purchasing. I think you mentioned she's already closed on like 6 properties and in process another 4 or 5. And so she just sees that basically all of the value in terms of just the appreciation and the fact that she can take the money here and make a lot more on that investment by investing in the Orlando market. Kind of the same reason why obviously I wanted to take some of my money here and do the same thing with Memphis and Orlando. Is it's really a no-brainer. Like if I went out to buy a property here in Temecula area, it's hard to find something that makes sense. So I'm not doing it. I don't even really recommend my clients, unless we find a really good deal, to purchase in this area, just because the numbers just don't work. But in markets like Orlando, it seems like a no-brainer. I remember when the return on investment here in Temecula was 6, 7, 8, 9%. But that was back when the market had tanked and values had dropped a lot. And it was a great time to buy because you could purchase almost anything and have a good cash flow from day one, where you're seeing those returns of the 7, 8, 9, 10% sometimes. We're not seeing that in this market. And that's why I love what you're doing in terms of buying in these hot markets, that you can go in and be around cash on cash, somewhere around that 7 to 8% ballpark. To me, it's a no-brainer, because how could you go wrong if you have that sort of return on day one? Rents rarely go down, even in a tough market. So anyway, she's one of our favorite clients, and we're gonna miss her because she's only got 1 or 2 more properties with us. But at the same time, I understand that I want her obviously to be able to position herself even better with the property she has. And she is thrilled, and she's obviously very happy with the work you guys have done for her.
Yeah, and she's been awesome to work with. I think we're talking previously, Tyson, some of at least one of the homes that she sold was around 400, 425, the value of the house, and it was bringing in low 2000s in rent. And when you look at the value of that house, we could go buy 2 of these houses in Orlando or Memphis, and we could essentially get $3,200 a month for that $400,000 asset versus $2,100 or $2,200 a month. And, it literally represented almost a 50% increase in her cash flow simply by just repositioning. And we utilized 1031 exchanges. So she didn't have to realize any of those capital gains. She still got 100% of the funds that she had, or the equity that she had in her homes there. We're able to roll into the other ones, which is, again, another benefit of real estate, where we can sell and we can defer that gain that we realize. So, really, that's where I see, the value, that you're offering to your clients is just exposing them to other markets that potentially could help create more wealth, or help them build their real estate portfolios faster than they're currently being built. And to tell you the truth, that doesn't mean they don't come back and buy in your market when the timing's better, right? But in the interim, let's go to a market, let's buy a stock, right? That's currently performing and projected to perform better than maybe where we're at right now. And then be mobile and nimble enough to be able to adjust and understand what the market's doing, so we can make adjustments as we go. And that's really the point of it. It's really turnkey. It's pretty hands off. You know, the hardest part with all of this is getting the darn mortgage. If you are financing, you know, that's the part that takes the most time for the clients, because you've got to kind of be plugged into your DocuSign, and you've got to, you know, get in your taxes and your pay stubs and do that piece of it. But I tell everybody the first one's the hardest. Once the team has all of your stuff, then when we go to house number 2 or house number 3, it becomes much easier, because now you're just sending over a couple updated statements or something like that.
Definitely. Hey, let me just shoot out a question. Jeremy's
Okay.
been patiently waiting here. Let's see. He asked, if you have $70,000 and want to invest in these single-family residences, what is the smarter option? Splitting into 2 down payments of 35 into 2 homes, or having the 20% down for 1 home?
Great question. So number one is, when you buy an investment property, you have to have at least 20% down. So you couldn't necessarily split that and do 2 10% down payments. The reason being is because the lenders, the mortgage, does not offer mortgage insurance on investment properties. They offer it on primary residences and second homes, but not on investment properties. So you're required to put at least 20% down. I actually like that, because it reduces the amount of risk, right? And allows us to create more cash flow out the gate by doing that. So with $70,000 down, I would recommend we go by 1, but that might only take $45,000 or $50,000. But then having a plan, if you were able to allocate that entire 70, and let's say you were willing to treat this like a new business that you're starting, you put it over on the side, it's your new real estate business, and you put, you know, you seeded it with that extra 25,000, and then we added the cash flow to it. What I could do is I could model out for you how soon you could buy house number 2, and then model for you how soon you could buy house number 3. And that's really kind of a lead into maybe another question, Tyson, which is, you know, if we were interested enough to explore this, what would the next steps be? And what I like to do is, each individual's different. Their starting point, the amount of money that they have to start, the age, their time frame, their risk tolerance, their goals, everybody's different. So I like to sit down and gather information and then show them, if you were to use this strategy, here's what this would look like over a 5, 10, 15, 20-year period of time, because that's where it gets powerful. You know, I'll circle all the way back to me, and then we can wrap up, because I know we're about at the hour and I appreciate everybody's time. But today I'm 39 years old and I've got 19 houses. And I started with that 1 house, and I committed to myself, this is my real estate business, and I'm not going to touch any money from it. I'm going to continue to generate income through my career, right? What I do full time, not my investment real estate. And I'm going to just reinvest everything that I get. So all that cash flow, that $50,000 of cash flow I have in my pocket from that first house, that was used to buy another house, right? And I've continued to just build and build and build and add money to it when I can. And today I'm at 19 houses. I have over $2.5 million of equity in those houses, about $14,000 a month in cash flow. And I haven't done anything spectacular. I haven't taken any crazy risks. I've just constantly bought, and I benefited, right? I just, as soon as I had enough money, I bought. As soon as I had enough money, I bought. And it didn't matter the market conditions, because I wasn't buying, I wasn't day trading real estate. I wasn't trying to time the market. It was just, I knew if I continually bought, that over time I'm going to win. So I bought houses in 2008, 9, 10, 11, when prices were really low. Well, I sold a lot of those houses and turned 1 into 2 and 2 into 3 to build this portfolio. And I like to tell everyone, there's this part of your plan where it's growth mode. That's where we're taking 100% of our returns and we're just buying. The more that we own, the more growth that we can have. But at some point, it gets to maintenance mode. Just like your stock guy is going to say, hey, do we need to start looking to get out of some of these high growth stocks and get into more safe stocks? Or do we need to start annuitizing your portfolio, or whatever it might be? There's a time and place to have that type of strategy for real estate. And so for me, my goal is when I'm 45, I want all of them paid off free and clear. So the last 2 years, I've decided I'm going to take half the cash flow and pick a mortgage and start paying them off. And so some of these houses I've had for 13 years, so I only owe $71,000 or whatever it is. So each year, for the last 2 years, I've paid off a mortgage. I'm going to pay off another one this year. So now I'm starting to own them free and clear. The second I do that, my cash flow goes up $1,000 a month because I don't have that mortgage to service. And it's just this snowball effect to pay all of them off. So I'm 45, I own them all free and clear, and now I've got $30 or $35,000 a month in residual income, which is life-changing.
Oh,
right?
And that's only going to go up. I mean,
yeah, only goes up over time. My rents are only going to go up, and my values are only going to go up, right? And then my goal for me personally, right, it's about the why. That's what it all comes back to, because that's how we're going to have discipline in our lives, right? It's why do I want to do that, and what's the purpose of it? Whether it's family, whether it's charities, whether it's you want to go travel, right? Everybody has their own why. But for me, it's if I can create enough residual income to live off of, I have so much more that I can leave behind to my heirs or to charities or whatever it is that's important to me. And it frees up my time, right? We've talked a little bit, Tyson, but I love coaching sports. All my kids do all these crazy competitive travel athletics, and we're all over the place doing sports with my kids. But there's nothing more I'd rather do than just be able to coach kids all day long. I love the impact that coaches can have, right, on kids. And it's not about the results you get on the field. It's about the results you can have in their lives, right? And the life lessons you can teach through sports. And I love it. But I can't go do it all day every day because I need a job and I need to make money. But if I can get to my goal, I could go be the best, most awesome coach ever, and I could sponsor all these kids that couldn't afford to go travel sports and do those things. And right, that circles back to my why and why I'm willing to continue to grow my portfolio and defer that cash flow today to ultimately get to my goal sooner and get the cash flow tomorrow. And that's for me, that's what I love doing for people. Real estate and my model's a vehicle to help people get to whatever that is for them. Yeah. And it's such an awesome vehicle.
Love it. Man, that is so cool. Jeez. And I know, man, I wish I had started a bit earlier, but it's never too late. We got to be smarter with our money. And Jeremy, I think he's a younger guy. So the fact that he's already looking into it, I wish I was a good 20, 25 when I started investing in real estate. Where it really makes sense like this. So, dang, appreciate your time, Tyler. I hope people really understand this. I know we get into the nitty gritty, and I feel like sometimes people get lost in it. But reach out to myself, reach out to Tyler. We'd love to help you. Truly, we want to help. It's more the reason we put on this broadcast is really because we want people to better position themselves, just like Tyler has. And I'm hoping to be in the same boat, little by little, accumulate some properties over the next few years. This is life-changing. This is going to give us the ability to retire comfortably and focus on our whys like Tyler. And so that's truly the reason why we wanted to do this broadcast. So feel free to reach out. Any questions? I'd love to help you guys. There's Tyler's contact information. Reach out to him. Shoot me a message. I can get you his contact information. But let's be smarter about the way we spend our money and invest. I just can't stop thinking about if I would have started doing this stuff 10 years ago and where I would be today.
Hey, here's my parting comment, Tyson. When I get up and do presentations and stuff, I show this picture of a Tesla. And this works for your California crowd because every time I go to California, there's more Teslas there than anywhere. But I show people a brand new Tesla that's $135,000. And then I show another picture of a 2-year-old Tesla that you can get for $85,000. And I'd like people to have the perspective of, for some people, that's a $50,000 difference. For other people, it's a $500 a month difference in a payment. For me, that's a house. And that house in 20 years represents hundreds of thousands of dollars in cash flow and in equity growth. So for me, that's more of like a $500,000 decision to buy a 2-year used versus a brand new.
Oh, yeah.
All right. And I use the analogy for Starbucks, for eating out at lunch, for all these different things, because there's so many areas in our lives where if we exercise a little bit more discipline, that we can just create massive results if we understand the power of time and we have a good plan for that difference, right? If we go buy the used car, but we go blow $50,000 on something else, it didn't matter. Right. But it's having that plan in place that is so important to me, and understanding what that plan looks like in 5, 10, 15, 20 years, because then that helps us be more disciplined today.
Oh, huge. Totally. Love it. I mean, geez. And that's how you've accumulated over $2 million in equity, is because you started that or started putting your money where it just makes more sense. You kind of push yourself to, sometimes it causes you to kind of stretch where you're at currently in terms of just investing in a property, but the payoff will be there. You just got to stick with it, and you'll definitely see the returns down the road, obviously, just like you have. And I have one of my guys working on my team. He hasn't purchased his first primary residence yet. He wants to buy his first investment property. And I'm like, hell yeah. Because if I was 25 or so and buying my first one, I believe that would be that catapult that would just make me want to go for my second and third and just be smarter with my money. And if you're starting at 25, it just makes a world of a difference 5, 10, 15 years. So the earlier you start, the more you're going to benefit just in terms of the growth over time. Obviously, just because real estate's an appreciating asset that over time is going to just yield. It's going to happen, and rents are going to increase. Cash flow is going to increase. So love it. Thank you, Tyler.
Yeah, you bet. Thanks for having me, Tyson. Thanks, everyone, for tuning in, and happy to continue the conversation, answer any other questions, and look forward to being in touch.
Okay, love it. Thanks, man.
Good night. See ya.
Yeah.